U.S. expats. The One Big Beautiful Bill Act changed a lot of U.S. tax rules. But here's the important question. What actually changed for Americans living abroad? In this video, I'll separate the headlines from the practical issues that U.S. citizens and green card holders abroad should actually review. The One Big Beautiful Bill Act was signed into law on July 4, 2025 as Public Law 11921. The IRS says it significantly affects federal taxes, credits, and deductions. But that does not mean every provision affects every expat. Some changes matter directly, some matter only if you have certain income, children, U.S. investments, remittances, or business activity. First, the standard deduction increased. For the tax year 2025, the IRS lists the standard deduction as $15,750 for single filers and married filing separately, $31,500 for married filing jointly, and $23,625 for head of household. For tax year 2026, those amounts increased to $16,100 for single filers and married filing separately, $32,200 for married filing jointly, and $24,150 for head of household. For expats, this matters because even if you live overseas, you may still file a U.S. return and calculate U.S. taxable income after deductions. Second, the foreign earned income exclusion amount increased for 2026. For tax year 2026, the IRS says the foreign earned income exclusion is $132,900, up from $130,000 for tax year 2025. But don't misunderstand this. A higher foreign earned income exclusion limit does not mean every expat should automatically claim the exclusion. If you live in a higher tax country like Australia, the UK, Canada, New Zealand, or Germany, the foreign tax credit may still need to be compared.
Is this the correct deduction amount here?
Yes, that is the one the accountant mentioned.
Third, there is a new enhanced deduction for seniors. The IRS says that effective 2025 through 2028, individuals aged 65 and older may claim an additional $6,000 deduction. For married couples, that can be $12,000 if both spouses qualify. The deduction phases out when modified adjusted gross income exceeds $75,000 or $150,000 for joint filers. This may matter for U.S. retirees overseas, but it is not automatic for everyone. You need to check the age, filing status, income level, and whether you have a valid Social Security number on the return. Fourth, One Big Beautiful Bill Act created new deductions for certain tips and overtime. The IRS says qualified tips may be deductible from 2025 through 2028, subject to limits and eligibility requirements. The IRS also says qualified overtime may be deductible with limits of $12,500 for single filers and $25,000 for joint filers. For Americans abroad, this is where you need to be careful. Not every overseas worker with variable pay or extra hours will qualify. These deductions have a specific reporting, eligibility, and social security number requirement. Fifth, there are family and child-related provisions. One new item is the Trump account. The IRS says parents, guardians, or others can establish a Trump account for an eligible child, but these accounts cannot be funded before July 4, 2026. The federal government will make a one-time $1,000 contribution for its eligible child's account, and authorized contributions may be allowed up to $5,000 per year. For expat families, the key message is this. Don't assume child-related benefits apply automatically because the child is a U.S. citizen. You still need to check eligibility, social security number rules, income phase-outs, and whether the benefit applies to your specific family situation. 6, and this one may catch attention overseas. An excise tax on certain remittance transfers was introduced. The IRS says that beginning January 1, 2026, remittance transfer providers must collect a 1% excise tax on applicable remittance transactions when the sender pays with cash, a money order, a cashier's check, or a similar physical instrument. This is not the same as saying every international transfer by every expat is taxed. The details matter: who is sending, how payment is made, what type of provider is used, and whether the transaction is an applicable remittance transaction. So, what did not change for expats? Now, let's talk about what did not disappear. One Big Beautiful Bill Act did not eliminate the U.S. worldwide income filing issue for citizens and green card holders abroad. U.S. tax filing may still apply, FBAR may still apply, Form 8938 may still apply, foreign earned income exclusion versus foreign tax credit still needs planning, foreign companies and trusts still need review, crypto reporting still matters, streamlined filing still matters for late filers. So, if you were hoping that this new law means US expats no longer need to file, that is not the case. If you are a US citizen or green card holder abroad, here is what I would review after One Big Beautiful Bill Act. Number 1, review 2025 and 2026 standard deduction. Number 2, compare foreign earned income exclusion versus foreign tax credit. Number 3, review child-related credits and eligibility. Number 4, senior deduction if age 65 and over. Number 5, tip or overtime deductions if relevant. Number 6, review your remittance transfer exposure. Number 7, review your foreign account and entity reporting requirement. Number 8, review your crypto and investment reporting. And last but not the least, review your prior year non-filing risk. The biggest mistake is assuming the headline tells you the answer. It doesn't. Your facts determine whether a rule helps you, hurts you, or does not apply at all. The main takeaway is this: One Big Beautiful Bill Act changed important U.S. tax rules, but Americans abroad should not rely on headlines. Some provisions may help, some may not apply, and some may create new reporting questions. If you are a US citizen or green card holder overseas and you have foreign income, foreign tax paid, children, investments, crypto, superannuation, business entities, or prior year filing issues, get your US tax position reviewed before filing.